Hello and welcome to this weekly market recap for the week ending Friday, May 30th, 2025. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. It's a pleasure to be with all of you again this week. Market held up pretty well last week. We continued to trade above 20-day moving averages for the most part in most of our indices. We've had some more tariff news, and I thought the market handled that pretty well. Interest rates, which gave us a problem there for a couple of days. Interest rates pulled back. The 10-year Treasury yield ended up down last week. So I think that gave the market a little bit of relief there. And of course, all the inflation reports that have come out have been benign. So really, there's nothing, and everybody's talking about inflation, keeps pushing it back a month, saying, well, next month is when we're going to show the tariff impact. Why didn't we show it this month? We had tariffs in place during the month of April. It made no sense that we still haven't seen any impact whatsoever from those tariffs. But anyway, media is going to say what it says, and I just ignore it and continue to look at the charts, which tells me in time we're going back to all-time highs. But let's go ahead and let me share my charts with you, and then we will get this thing going. All right, let's take a look at what happened last week first. So you can see the NASDAQ led on a relative basis, gaining a little over 2%. S&P 500 up almost 1.9%. Dow Jones 1.6%. The small cap Russell 2000 up 1.25%. Transports up 1%. Mid caps lagging the rest of the field there, rising 0.8%. Moving on to the sectors, it was an interesting week. We had 10 of the 11 sectors up. Real estate, though, was the leader. Real estate hasn't performed very well, so we did get a little pop in that group, maybe a little bit of a, dead cat bounce. Real estate, though, gaining 2.7%, so easily the leader last week. But then we had financials. It was kind of weird when you look across the board. We got financials and technology, both doing well, gaining around that 1.8% level. And then we had two more defensive groups, healthcare and consumer staples. And consumer staples slightly outperformed discretionary, both up about 1.5%. Industrials, communication services, and then down at the bottom, you can see utilities, the final defensive group, and then what I like to call the neutral groups, materials and energy. They tend to go up and down no matter what kind of market we're in. They can lead at any time. They're influenced by a number of things, including geopolitical events and concerns, the direction of the U.S. dollar. A number of things come into play there. But I tend to focus on the three most aggressive groups. When I look at the market and I see the market rallying, I really want to see what those three aggressive groups do. And that for me, those groups for me are the technology, consumer discretionary, and industrial areas. And all were up, but all did underperform slightly the S&P 500. Still, all in all, I would say it was a pretty good week. Moving on, taking a look at the S&P 500. This is what I was talking about the Friday before last. So about 10 days ago, we had that test of the 20-day moving average. We rallied off of it. We've continued to trade off of it on Friday. We were down considerably intraday, and we managed to rally back late in the day to get back up above the 5,900 level. If we take a look at that intra-day chart on Friday, you can see about midday is when we put in a hammer and rallied all the way through the afternoon, finishing pretty close to the highs of the day. So we've seen a lot of that lately. That's why when we go back to the S&P 500 and we pull up the AD line, which is right here, check this out. I mean, even though we're not at an all-time high, the AD line has been soaring even since topping back in February and seeing that big decline. The AD line just kind of went sideways and actually started to rally pretty strongly once we hit that bottom at the end of the first week in April 7th at that low. So as soon as we hit that bottom and started moving back up, you can see the AD line very, very strong. And that's the way it looks across all of our indices. And especially, I really like the way the IWM and the mid-cap AD lines have turned around. I'll get to those in just a minute. NASDAQ 100, big rally off that April 7th low. That continues. We're continuing to trade above the 20-day moving average. And like the S&P 500, you can see very, very nice recovery late in the day on the QQQ. So it was nice to see the major indices finish off last week pretty strong heading into the weekend. IWM, small caps, I'm going to go ahead and pull this up with that AD line, because the AD line was really struggling. Even when the IWM was going up, I kept talking about the fact that we weren't getting the same type of accumulation, or at least not the appearance of it, that we were seeing on the other major indices. And the same thing with the mid-cap index. But when we started going down, notice the AD line on the IWM did not go to new lows. So we went down this entire time looking like maybe we were seeing a little bit of accumulation. And then May 7th, once we saw that move to the upside, look at the AD line take off in small caps. So this could be a precursor to a much bigger move down the road in the small caps. I would say they're still underperforming the QQQ, but keep watching them, because there's no need at this point to overweight in the group. We did that last year. Rates were coming down. I thought it was the perfect trade. But once the Fed turned more hawkish again and stopped lowering the Fed funds rate, that's when we saw a lot of the trade in the second half of 2024, like small caps, like the transports, financials. That's when they started to turn a little bit and not perform quite as well. But during this pullback, you can see that the AD line held up, which I think was a pretty good sign. And then again, once we started rallying off that April 7th low, we're seeing a ton of accumulation, even during this consolidation period here of late, where we've pulled back close to the 20-day moving average, tested it again on Friday, by the way. All of this sideways action is still coinciding with a very, very strong AD line. I like that. All right, one chart that I've always put into our weekly market report for our members at Earnings Beats is this intraday kind of rotation that I like to look at on the XLY versus the XLP. Now, if you look at it, this ratio was starting to deteriorate beginning in December of 2024. And by the time the market actually topped, that's where this red dotted vertical line comes in. By the time we topped, this ratio had already been going down for quite a while, and then actually started to plummet when the market hit its top. Remember, this is when we saw the relative strength. I think it was February 19th was the top, which I think was a Wednesday. And February 21st, we had a day where discretionary got absolutely just crushed during the trading day. And staples took off during the trading day, which that's why you're seeing this massive decline right in here. Major rotation into the defensive area of consumer spending. And that's never a good sign. And so this was a little bit of a warning sign, and actually a pretty big warning sign. One of the things I pointed to when I said, you got to be careful back at the end of January and into early February. That was lining up with some other bearish signals. I was calling for a correction. It turned out to be a cyclical bear market. We ended up losing 20% on it. But right at the bottom, or actually just before the bottom, remember the bottom on the S&P is down here. It came in early April. Look at when this ratio bottomed. It bottomed a month earlier, 3 or 4 weeks earlier. And we started seeing that rotation back into the more aggressive discretionary. This is why we provide this chart to our members every week. Now, this isn't the biggest indicator. It's a secondary indicator, but it's one I do pay a lot of attention to, because consumer spending is 2/3 of our GDP. So knowing where money is rotating to within consumer spending is kind of a big deal. And so anyway, for what it's worth, last week we did see this intraday rotation start to turn south again. I don't know if that means we're just going to be consolidating on the S&P 500. It's very unlikely that we just take off to the upside if this starts to roll over. And we do have a double top, and the low in between the double top was taken out on Friday. So Friday, on the one hand, looked pretty good. A whole week we talked about, S&P up 1.88%. Saw a little bit of lagging in those three aggressive groups. Also saw this rotation, which was a little bearish, mostly Thursday and Friday. So this, again, is maybe just a little bit of a red flag for us going into this week. But then on the other side, you've got history, which tells us this is one of the best historical weeks. So a lot of our secondary indicators are just kind of battling one another. They're not really lined up in any one direction. So I think you just got to be ready for some back and forth whipsaw kind of action, especially as traders. Long term, I wouldn't even be paying any attention to this. Long term, I love the long term. I think we go back to all-time highs. I'm talking about what's going to happen over the next 1, 2, 3 weeks. And that's where we could see some choppiness. I'd love to see the market break back out to new highs. But if it does, we want to see this intraday rotation change. But again, this is one of the biggest things I don't look at it every day, but I think once a week is a good amount of time to just kind of look at, see what's going on. But it gives us some excellent signals about the overall market, where the market might be going, and if the market's going up and these ratios are this particular ratio is going down, could be a little bit of a warning sign. But anyway, if you're not already a member, you certainly can become a member and start receiving this along with a lot of other things we do at Earnings Beats. But I wanted to point this out because it did look like getting a little bit of negativity coming in to the market on Thursday and Friday, even though we did have that nice rally on Friday afternoon that I just spoke about. 10-year treasury yield. So, I get a kick out of the media, and I don't watch the news on TV, but I do follow headlines. I go over to CNBC.com, I check out futures, and I'll see headlines. And that's as far as I go. I don't click on anything. But last week, twice, there was, or maybe it was the Friday, it might have been the Thursday or Friday in the week before, but there's been like 2 or 3 times in the last week where they were trying to decide what was causing the market to go down. And they were talking about interest rates going up. But notice you don't get those same headlines when you got the 10-year treasury yield moving lower. It's like that gets ignored. And then we'll talk about tariffs, because tariffs are going to be the next. Before that, it was inflation. But with the CPI and the PPI and then the PCE coming out last week as part of the consumer spending and income report, that was tame. It's like the inflation folks have nothing to talk about. So, and right now, interest rate folks have nothing to talk about. So let's talk about the tariffs until we can't talk about them anymore. I mean, that's just the way the market works. And so I ignore all that. I look at my intramarket relationships and sentiment. I look at, momentum, divergences, and then just take a look at some of the leaders in the market and see what they're doing. It's not rocket science. It's just looking at the charts, the AD lines, giving us great signals right now. So the signals that I do see that are maybe a little bit bearish are mostly short-term in nature. So here's the inflation. I wanted to pull up the CPI, core CPI, because, if you just have followed the Fed for the last 3 years, and I talk about this often, so I hate to keep rehashing, but at the same time, we got a lot of new viewers that come in. And so I do want to talk about it from time to time, just to let everybody know what the heck the Fed has been doing for the last 3 years, which is being late to every single party they go to. And right now they're still talking about inflation. They're worried about inflation. They've even brought up stagflation as a possibility. The other possibility is the S&P 500 goes to 7,000, but they don't talk about that one. They're only talking about the possibilities that could require them to either raise rates or just leave them where they are for a while. Because most everything in the market is in the stock market and the bond market is pointing to the Fed needing to lower rates. And the Fed just keeps ignoring it. But they've had this history. They've had this history for the last 3 years. They've been getting everything wrong since the pandemic. For a while. They get it right eventually. And I had somebody write on one of my videos or something saying, that I felt like I was smarter than the Fed. That is completely false. I think the Fed is loaded with brilliant people. I just think they're moved too slow. I don't think they react to their signals or to the market signals as fast as they should. So I think they eventually get it right, but I think they put a lot of retail investors at risk during periods when they get it wrong and the market takes big drops. There was no reason for the market back in February, March to take the drop that it did. The reason was the Fed stopped cutting rates. Europe kept cutting rates. The dollar fell apart, market fell. They're going to eventually get it right, and the market's going to be back, and everybody's going to, be happy at that point. But in the meantime, I think they've made mistakes along the way that have cost a lot of individual investors a lot of money. And if you think I'm smarter, I'm trying to say I'm smarter than the Fed because of that, that's fine, go ahead. But I just feel like the Fed has made timing errors, many of them, and I think they've cost a lot of people a lot of money. And I don't think that's a great idea. But if you've been following us, we've been calling tops and bottoms since the pandemic. I don't think anybody's been doing it any better than we have. So anyhow, here on the inflation front, I just wanted to point it out because it was back in 2022 when we were in a cyclical bear market and they were asking the Fed what needed to happen for them to lower rates. They started talking about, first, they just needed to see the CPI, the annual rate, start to drop. And then they said they needed it for more than just 1 or 2 months. And then they said they needed a sustainable move to the downside. Took them 2 years, 2.5 years to start cutting rates. Look at what it did. I mean, tell me what part of that is not dropping, which part of that is not sustainable. I mean, last 3 years, they finally, in the fourth quarter of 2024, started to lower rates. If that's not late to the party, I don't know what is. And now they're still worried about inflation going up. And every single inflation report coming out is tame. It's benign. I mean, I think you worry about a problem if it starts to show some signals, some signs. We went through a long rate raising campaign. I think cutting quarter basis point at a time really wouldn't be that big a deal. And you could kind of follow the data over time. That's all I'm saying. I just think they're late. I think their next move is going to be a cut. And at that point, the market goes back up. But February and March could have been avoided if the Fed had acted on time. That's my point. The Dow Jones, I talked about the Dow earlier. The Dow's been kind of hanging in there. We do a lot of stuff at earnings beats, with all the major indices, obviously. We do have a twice a week newsletter, EB Digest, where we might talk about the Dow, we might talk about the S&P, we might talk about some of our signals that we like to follow, or it could just be a lot of individual stocks, that we follow. Trade candidates, they could be showing, that they're hitting gap support, trend line support, price support. Might be a pattern, could be a triangle, could be, head and shoulders that I'm pointing out. We try to make these very educational articles. And when I say articles, it's really a chart in 2 paragraphs. Very simple read. It's going to take you about 2 minutes in the morning, and they come out on Monday and Wednesday, and it's free. We do this from an educational perspective. We've had tens of thousands of folks subscribe. So if you haven't already subscribed to this, do it. It's completely free, no credit card required. You can unsubscribe at any time. Name and email address is all it takes. And in this morning's EB Digest, we actually started a new chart list last week. It's kind of like a debut, and we may have some more momentum type chart lists coming out. But anyway, we started one last week. It's leading stocks and leading industry groups chart list. So I call it the leading stocks chart list. And last week we had probably about 60% of the charts or stocks on that chart list beat the S&P 500. And that's the idea. The idea is to try to put together a chart list where your odds are greater of finding stocks that are going to outperform the S&P. Now, if you're just unlucky, maybe you hit the ones at the bottom every week. But if you've got a chart list which can, maybe outperform to the tune of 60% of the stocks, that's going to give you an immediate advantage over the rest of the market. So anyway, anybody who had subscribed got this morning's EB Digest, and I provided a link and a password where you could take a look at the chart list if you're a non-StockCharts member. But if you're a StockCharts member, Extra or Pro, you could actually take this chart list and just download it right into your account. Now, this chart list will be updated every week. So if you want to get this every single week, you need to at least start a trial at Earnings Beats. You can do that up top here. Start your 30-day no-cost trial. You do have to provide a credit card for that, but we will remind you by the end of your trial period that you're going to be charged. So we'll give you plenty of opportunity to cancel. We don't want you to be subscribing and paying if that's not really what you want. Anyhow, just wanted to point all that out. Last couple things. So about this chart list, I just wanted to talk briefly about it. First, what we do is we go through all of the industry groups and try to find the best looking relative to the S&P 500. So for instance, one group that I included for this week and for last week was semiconductors. Look at semiconductors. Just when they start moving, other industry groups, if they looked like this, I don't know if I would include them. But when semiconductors get going, they can absolutely explode to the upside. So by the time you have these big moves, a lot of the gains have been made. So we tried to start it a little early here when we went through that 20-week EMA, that relative 20-week EMA. But semiconductors look good here. How about software? Software has been on a roll, cleared the downtrend line over the last 2 months, one of the strongest groups in the market. Let's see some of the others. How about electronic equipment? Look at this group since late March, just exploding to about a 2-year relative high. So these are the types of groups that we want to include. Now, last week, I'll show you one group I included that I took out this week. And that was specialized consumer services. So it was still up here about a week ago. After we pulled back a little bit, but then we had another big pullback and we kind of lost the breakout level, lost that rising 20-week relative EMA. And so I decided to pull it off this week. The group's not been performing well for the last 4 weeks. And so pulled it off. One of the groups that I added, let me see if I remember it. I'm going to show it to you in just a minute. One group that I looked at, I didn't add, was broadline retailers. That bounced and it's starting. We get a breakout this week. You're probably going to see that on the list next week. Where was I think I added a couple in industrials. Waste and disposal services came down below the 20-day and bounced back up again. This has been one of the best performers year to date in 2025. And last week it started to bounce back up again. So I included it. Or actually over the past couple of weeks. Last week it went down just slightly. But that was the one that I added. Another one was diversified industrials, which what I'm looking at down here on an absolute basis, it looks like the group is right on the threshold of a breakout. And it's sitting back up near a 52-week and actually a 3-year relative high. So I added this one in. So what happens when I add it in? Well, here are the leading stocks in the leading industries for last week. So this is not the one that we gave away today. The one we gave away today is for this week. But I just wanted to show you, this was a stock that I featured on the Earnings Beats Digest. This is just intraday, by the way. So this was a Friday thing. If we go back 1 week, you can see Zscaler was number 6 out of, I believe, 47 stocks. 48, but it includes the S&P. So 47 individual stocks. And let's go back up here to summary again. And for the week. So here was top groups. Now look at the industry group that's near the top. Software. One special consumer services group here, PRDO, and another one, Groupon, GRPN. Now remember, we removed specialized consumer services for this upcoming week. So both of these would fall off because I don't consider the group any stock within the group. So there's still going to be individual stocks that do well outside of the chart list that we create. But what we're looking for are the leading stocks in leading industry groups. So we want to make sure that industry group keeps its relative strength to some degree. It's some judgment, some from experience, some judgment, and some just flat out look at the chart and you can't help but include it. Aerospace is one of those. Let me go over here and show you Aerospace. When you're looking at the best groups, how could you not include Aerospace? Since December of last year, aerospace stocks just going through the roof. This is on a relative basis. Here's the absolute basis. So we had like a double top in the 2350 area. We're now at 2677. That was, I mean, we were at under 2000 2 months ago. And now we're up 2677. So we're talking about 35% moves to the upside in 2 months. I mean, aerospace absolutely on fire. You couldn't possibly not include them. But anyway, there is the groups. And by the way, if you wanted to come in here to this and said, well, I just want to look at the aerospace because that's the best group. So you type in aerospace. Here's 3 stocks on this list. They're the 3. And, you know, we could add columns. We could put in the scooter, which kind of gives us the StockCharts technical rank. We can sort it, scooter order. So Astronics, Boeing, and Redwire Corporation are 3 stocks in that order in terms of relative strength based on the scooter. Those are 3 stocks to consider, especially if we get a little bit of a pullback. So anyhow, let's keep moving. So here was the scan I ran. Now you can't run this scan in your account because down here at the bottom, I am pulling off the number, the ChartList number that's in my account. ChartList number in your account, even if you have these same chart lists, are not going to necessarily be numbered the same in your account as they are in mine. Our accounts are unique. So what you'd have to do is make sure you have the strong earnings chart list and raised guidance chart list downloaded. And then you'd have to run a scan by going back and figuring out whatever groups you want to include, and then add the 2, whatever chart list you want to include. And then also I've got this scooter greater than 90 just to make sure that we're getting high scooter stocks. And I think that this is a great way for momentum traders to come up with some great candidates to trade. So that's how we do it. But that's essentially what I had for you today. Always appreciate you tuning in. Please hit the like button down below and subscribe to the channel. If you like our approach to the market, we've been doing this for a while. We're trying to build our community. So even if you can't afford our service or for whatever other reason don't want to take out our service, paid service to help us, you can help us by simply clicking the like button and subscribing to the channel. That will help us build up our YouTube community. Everybody have a great week this week. Good luck in your trading. Happy trading.